Good morning. Western economists and think tanks have been predicting the demise of China's economy for a long time. There are a handful of YouTube channels that do the same thing. The economy here was supposed to have blown up a long time ago. And it's on the issue of deflation, falling prices, that commonly trips them up. Deflation is a real thing here. The prices for almost everything are gradually falling over time. To Western economists, that is a serious problem. And that's because in the West, debt levels are a lot higher. And so in the West, deflation is a serious problem. Falling prices means lower profits or even losses. And losses mean that debts cannot be repaid. And the value of the equity, stock prices, lose their premiums and they fall. Since the debt is more difficult to repay, banks are more reluctant to lend. And they have to write off bad debts, which means the banks themselves fail. Inflation, the gradual erosion of the value of the currency, means that loans taken out today become easier to pay back over time. Deflation is the opposite. Entire industries become unstable, and recessions and even economic depressions follow, and governments race around trying to bail out banks that are going under. So when those same observers watch the chronic, persistent deflation in China, they expect the same inevitable outcomes. But it is a different world here. We, like Ryan Perkins, take here on his Substack. Chinese-style deflation is a result of everything supply chain, the access to the raw materials on a global scale, world-class infrastructure and logistics, affordable electricity also falling in price, a labor pool that's increasingly better educated at far lower costs than in other countries. These are supply-side factors that are driving costs lower, relentlessly. Investments in strategic sectors have driven massive gains in efficiency and scale. As a result, consumer prices are falling also. Household goods are less expensive as Chinese factories are building just more of them, better and at lower costs. He concludes there that this deflation is a byproduct of industrial success, not economic failure. To Western business executives, it is an economic failure. Our companies expect that greater efficiencies should result in booming profits and higher stock prices. But China's financial system is radically different too. The banks here are state-owned, mostly, so they don't run the risk of a Lehman Brothers-style contagion that blows up the entire system. Chinese banks provide the capital to aggressively expand the supply side and remain healthy even as consumer prices fall. We'll go a bit further here too. Falling prices on homes and cars, for example, frees up consumer and household spending on electronics and on clothing and on vacations. And those companies are banking customers too. So yes, there is deflation. And in conventional Western thinking, the Chinese economy is growing in spite of it. But we've got that backwards. The Chinese economy is growing because of it. We need a comprehensive rewrite of our understanding of China and of deflation and of economics in general. Our top policymakers believed that the popping of the Chinese real estate bubble would cause the economy here to collapse, because that's what happened at home. They believed that chronic deflation would cause the economy here to collapse because that was a feature of our Great Depression in the 1930s. What happened instead was an industrial and supply chain boom unprecedented in world history. A great source of inside information is a private business school here in China. The Cheung Kong Graduate School of Business is an executive management school. They offer programs for foreigners too, in English thankfully, but most of their students and graduates are executives in Chinese companies. So far, 23,000 graduates, and half of them are at director level or above. And for over a decade, the school has done research and reports that tell us how the policies are playing out across industries and even at the individual company level. They also publish proprietary business indices, and we'll look at a couple of them today to show the deflation phenomenon here. The Business Conditions Index works like the PPI. Any reading above 50 means rising or expansion. A value below 50 means it's falling. So every month, this survey asks top business executives about conditions in their own businesses. And these businesses are across a spectrum of industrial sectors. This data set is for intermediate goods prices. So they're asking hundreds of business owners in manufacturing or wholesaling, are the prices you're paying for intermediate goods rising over 50 or falling under 50? The index value is 31.3. So economy-wide, intermediate products are falling a lot and almost everywhere. The last time that index was over 50 was 3 years ago, April 2022. This is for consumer prices. So they're asking the prices your company will be charging to final customers. Do you expect your prices to go up over 50 or down? So at 47.9, these company managers are planning for lower prices. Here we charted profits in red with consumer prices in blue. So profits are also being driven lower. But let's remember again how Chinese policymakers see these data. The supply chains are getting stronger and more efficient, and businesses expect their costs to be falling over time, and they're making plans accordingly. So lower corporate profits and falling consumer prices are not problems to be solved. It means that rent-seeking profits are being purged from the Chinese economy, and everything is working just as they hoped. This is Shashan in Anhui. Be good.